Most people believe they understand gold and silver. They think that when stocks crash, gold and silver automatically go up. But this belief is dangerously incomplete. When markets first crash, gold and silver often do something that shocks people. They fall too. Today, I'll walk you through what really happens, so you understand the sequence and don't panic. When a stock market crash starts, the problem isn't fear, it's liquidity. Hedge funds face margin calls and institutions need cash immediately. In this phase, investors don't sell what they want, they sell what they can. Gold and silver are highly liquid, so they get sold to raise cash. They fall not because they failed, but because they worked as a source of funds. Silver, being a key industrial metal, gets hit even harder as economic activity freezes. Seeing this, weak hands sell, wrongly concluding the metals don't work. But then, the turning point arrives. Central banks step in. They cut rates, inject trillions, and fire up the printing presses. The crisis shifts from a liquidity problem to a confidence problem in the currency itself. This is when gold's real role begins. Gold is not insurance against falling stocks, it's insurance against currency debasement and desperate policy decisions. It bottoms quietly after the panic, then trends higher for years, protecting your purchasing power from what policymakers do next. Silver's recovery comes later, but it's far more dramatic. Once liquidity returns and inflation fears rise, silver doesn't just recover, it surges, often violently outperforming gold. It punishes impatience but rewards understanding. So here's the sequence. Stocks crash and everything sells off, including gold and silver. Central banks respond by weakening the currency. Then, gold rises steadily, and finally, silver explodes higher. If you don't understand this sequence, you panic. If you do, you stay positioned.